So one of the first points that Yoko mentioned was that, can we talk about business structure? And as a simple and a straightforward question as that may seem, the answer is never as simple. It's a complex answer based on your own circumstances, your situation, what you're looking to do, how many people are involved, what kind of property project is it, are you trading, is it an investment? So I thought I'd just highlight 5 or 6 things that I think you should be thinking about when thinking about the structure. These 6 things are by no means exhaustive, and the list can be much longer, but at least this helps you make a start. So one of the first things you should be thinking about is liability. So you should be thinking about, what liability am I going to have based on what structure? So to make it really simple for you, if you have a sole trader business, then of course you are personally liable. That means if anything goes wrong, anybody you owe money to can sue you, and you'll have to personally pay for the debts, which means you might have to, if you have a property in your name, you might have to sell the property to pay those debts. If you have money in your personal bank account, you may have to use those funds to pay for those debts. Whereas if you have a limited company, for example, then the company is a separate legal entity, and you are not personally liable for the debts of the company, generally speaking, unless you do something fraudulent or negligent, which is usually pretty difficult to prove. So liability is one of the issues and the areas you should be thinking about. Above and beyond that, something linked with that is taxation. So you should be thinking about what the tax consequences are going to be to you on using different types of structures. And what I find quite often is that perhaps some advisors and also some investors are sometimes fixated on a particular type of structure or a particular type of vehicle, and that is probably the worst thing to do, because there are some people out there who swear by only ever having a limited company. There's others out there who perhaps say partnerships are the best, and the answer really is it depends. So always consider all the different types of structures to figure out which one works best for you. Above and beyond obviously liability, think about tax. So just to carry on from the earlier example, if you are a sole trader business, then you have to pay tax based on the profits your business makes. If you are a limited company, the company pays corporation tax, but you don't personally pay any tax unless you take some of the funds out. So if the money stays in the limited company bank account, the company pays 19% corporation tax, the rest of the funds stay in there. If your sole trader business makes profit and all the money stays in the sole trader bank account, you don't take any money out personally, you still pay tax on all the profits because you are the company. And now that might seem a very elementary point to most of you, but there might be 1 or 2 people here who perhaps aren't fully aware of that. Something else which you should bear in mind is how much is it going to cost you to run the company or the business. So if you have a sole trader business, for example, the accountancy costs are going to be less than having a limited company because there are more requirements. Above and beyond that, the 4th thing you should be thinking about is the ease of managing the business. So if you're a sole trader, it's pretty easy to manage that business because there's not that much regulation. Whereas if you have a limited company, then the rules are very different. The 5th thing you should bear in mind is, what are the consequences and how do I bring other parties on board? Sometimes you may have a limited company, you may have a property development project and you want to bring in a joint venture partner or an additional shareholder, then the consequences of bringing them in have to be fully considered. The 6th thing you should be thinking about, which is linked with ease of management, is the statutory regulation involved with running your business from a pure structure point of view. So if you have a limited company, the rules and regulations are more stringent because you've got Companies Act to deal with, you've then got Companies House there as well. Whereas if you're a sole trader, the rules are a bit more relaxed. So those are the 6 initial things you should be thinking about from kind of purely a tax point of view, but there are, like I said, many other things for you to consider from a business point of view. And I did, in fact, write a very long post about some of the key considerations. So Yoko, if you make a note kindly and perhaps come back to me, I will find that post which covers in detail some of the more deeper things people should be considering when deciding on which business structure to use. One key element that I find people usually miss, and this is something which you should always do, is if you're in a partnership, be it with a family member or a friend or husband or wife or husband and wife, please make sure you have a partnership agreement. Far too many businesses go into partnership, don't have a partnership agreement, especially husband and wife, generally speaking, thinking what could possibly go wrong in our business. We're deeply in love, we've been married for the last 25 years, we've got 2 children, and we've never ever had an argument. Why would we need to have a partnership agreement? I can tell you from experience that things do go wrong, and when that happens, if you don't have a partnership agreement, it's going to be more painful and more costly. So please make sure you have a partnership agreement, whether it's husband and wife or whether it's an arm's length business partner. If you have a limited company and you're shareholders, then of course you can't have a partnership agreement. In that case, you should have a shareholders agreement. Again, both of these agreements aren't very expensive. Depending on who you speak to, you can get one drawn up for, say, around about £750. Some firms will charge you more. The bigger the firm, the higher the charge, but it's money well spent. So partnership agreement, shareholder agreement are things you should seriously consider having. If you don't have one in your business, by the way, that's one of the first things I think you should do. Above and beyond that, Yoko said, can you talk a bit about incorporation? So I won't go deeply into incorporation because that conversation in itself tends to last about an hour. So what I thought I would do is, as a broad brush approach, share with you some of the pros and cons of incorporating a property portfolio. But if you're thinking about incorporating, I would say to you, the first thing you need to do is to make sure you can demonstrate you have a business. And if you look at the Elizabeth Moyne Ramsey case, that will give you an indicator, give you an indication, in fact, of what constitutes a business. So generally speaking, you've got to have a property portfolio. You've got to have, you should be spending 20 or more hours in your business a week, and ideally your property should be managed by you and not a letting agent. So some of the pros of having a limited company are, and the most obvious one, which is why most people want to incorporate, is you can claim 100% of your interest costs. That's one of the obvious benefits. Above and beyond that, if you have let's say a sole trader or a partnership business, a property business, if you incorporate and you have a business and you can demonstrate you have a business, you won't have to pay capital gains tax when you incorporate, because you claim Section 162 incorporation relief. If you are a partnership and you incorporate, you won't have to pay stamp duty, land tax, as long as you meet the rules. But if you have all the properties in your own name and you incorporate, you can escape capital gains tax. If you have a business, you won't be able to escape the stamp duty, land tax. Above and beyond that, one of the biggest benefits of incorporating, in my opinion, depending on the value of your properties and the equity, is when you move your properties from your own name into a limited company, you have an uplift in the base cost of those properties. And I've covered that in some detail in the book that Yoko referred to, which is the Property Investors Tax Guide. So look at that and think about the increase in the base cost. But of course, the base cost is also determined by the equity and the value of the mortgages. So you need to tread very carefully in working that out. Above and beyond that, another benefit is if you have a limited company, you can control how much money you take out. So you can take out a salary which goes up to your personal allowance or to your national insurance threshold, and the rest of the money you can take out by way of dividends. That can be more tax efficient and usually is. One other point that I've already covered for you, which of course is that if you have a limited company, you've got limited liability. To some people that's important, whereas obviously if you're a sole trader or a partnership, you've got unlimited liability. And the final point I want to cover in terms of a benefit of incorporating is you can then look at inheritance tax planning once you incorporate your property portfolio. So those are some of the benefits of incorporating. There are other benefits too. Some of the things that you need to be aware of when you incorporate, so some of the cons are when you incorporate, you'll incur legal fees. So include those into your calculations. You'll also obviously have to pay for valuation fees, especially if you've got mortgages. You might have to pay a higher rate of interest, so consider that. And sometimes people, I think, without fully considering all of the financial implications, are perhaps told by somebody that they'll have to pay more tax because they can't claim all of the interest as a sole trader or a partnership. They then end up jumping out of the frying pan into the fire. They end up incorporating, and then they find out the increase in the interest rate negates the tax saving on incorporation. So make sure you figure that out. Now interest rates are becoming more competitive, and there are more lenders now who are offering mortgages to limited companies compared to say 4 years ago. So that is becoming more competitive, but still consider that when you look at the numbers. And then of course, if you have mortgages, you'll have to pay arrangement fees. Also obviously think about the stamp duty land tax implications, and also bear in mind that if you have property in your own name, if you sell that property, you have your annual exemption for capital gains tax purposes. If you move those properties into a limited company, you are going to lose the annual exemption, because companies do not have an annual exemption, and companies do not have a personal allowance that only applies to individuals. And if you incorporate, of course, you lose some of your privacy because your information is publicly available on Companies House. So if keeping things private and confidential is a key determining factor for you, then perhaps incorporation might not be something that you want to, or that journey that you want to embark upon. I can see a question here, Yoko from Trang, I think it is, and it says, when applying for a mortgage under a company, director has to be the personal guarantor, or is it still down to the director's liability? So I'm not too sure what the question there is, but if the question is, will you have to give a personal guarantee, then the answer is it depends on the lender. So some lenders will ask you for a personal guarantee, some might not. So, but if you do give a personal guarantee, then basically you've lost the benefit of limited liability, because then you are personally liable. So where possible, avoid giving a personal guarantee. I know that's easier said than done. If you can, good. If you can't, then you are going to lose the limited liability benefit. If anybody has any other questions, please type them in there. Something else which I know I'm running through this quickly, but the point of this conversation really is, like I said, to raise your awareness rather than to do a deep dive. But I have promised Yoko that I will come up into the Northwest at some point next year, so then hopefully we can cover this in detail.